Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in your video is general in nature. None of it should be relied upon as any form of personal advice. FP Markets is not your personal scenario nor your personal financial goals. Therefore, none of it should be relied upon as any form of advice at all. It is just general in nature only. The playbook remains the absolute playbook to be in, and we continue to be very, very strong on this topic. The reason for it is that at the moment, we continue to see that the long US dollar trade is very much there, and that is on the basis that real yields are going to rise. That real yield is clearly playing out very, very strongly. We saw the movement go for the 10-year from around about 119, 120, they moved up to 130 leading into the FOMC, it even got as high as 140, and now we're through 155. It has eased off a little bit, but in saying that, the question you've really got to ask yourself is, where does it look like in March next year, and where does it look like in June? And the probability of it trying to do what it did at the start of this year is pretty high and probable. We did also see the other part of this whole discussion is that the Fed remains absolutely on point with communication. It doesn't matter who you looked at last week, they all basically said the same thing. They all use their own different colourful language, but the same thing was this: we've reached what we need to move on quantitative easing. The usefulness of quantitative easing in the current environment is probably over. We have got to a basically sustainable full employment levels that we want, and therefore we're going to start in November. They also very clearly stay on point around liftoff. It is separated from quantitative easing, and that the hurdle required to get there still hasn't been reached. Most of them also last week that were out there in the public domain are suggesting that if liftoff was to happen, it's most likely 2023. So it's a quantitative easing story here and now. But getting back to how to look at this from a trade perspective, it is clearly euro and it is clearly yen. I'm going to start with the euro because I want the yen to be the final thing to talk about. Euro dollar has moved from around about 119 down to 117, and then it really fell away as yields took off last week. It's now below 115 for the first time since July last year. And that should be a really big signal that this trade is what you need to watch very closely, because the ECB has clearly moved itself out of the market with regards to tapering from quantitative easing, and they clearly want to continue to support the European economy for the foreseeable future. Therefore, it is a dollar story, and the euro dollar sort of conundrum differential, if you want to call it that, is playing out. And I actually see a reason to see not only 115, but it could even go towards the 114 handle pretty quickly as we lead into November, and then also as we get to the understanding about how fast they're going to actually do QE tapering all the way through to June next year. Then the one that matters, dollar yen, the one that I really was quite strong on last week. It got to 112 faster than I expected, and I'll put my hand up and saying there, but that's where we wanted it to go. It did ease off when real yields came a little bit back, and it's at 111.50 as I speak. But 112.50 and even higher looks really probable, because every time you look at US real yields, the yen tends to fall about 1% and a bit per month each time it does that. And that is not likely to change anytime soon. And that is what I think is really interesting about the whole scenario now, is that you've got very clear historical trades to look at. You've got very clear playbooks that have been given to you by the Fed, and therefore don't get too big on it. Just keep watching it and follow the momentum. And the momentum in both of those pairs is clearly long the US dollar side.